Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss one of the most common client questions. Are we in a bubble? As markets reach new highs and AI stocks continue to rally, it's natural for investors to wonder if we're experiencing another bubble like the dot-com era or the housing boom. While the concept of a bubble is often taken for granted, it's actually surprisingly hard to define. This is because markets naturally go through cycles, and how we perceive risk changes over time. Investors often focus on the dot-com and housing bubbles, but there are many other cases where investors feared bubbles that never occurred. So the question, are we in a bubble, should be distinguished from, will the stock market experience a setback? Short-term declines are completely normal and can happen without notice. Just earlier this year, the S&P 500 declined 19%, but bounced back in less than 3 months. Many who tried to time the market during that period likely found themselves on the sidelines as it recovered. Let's start by discussing valuations. There's no question that they are currently elevated. This chart shows the Shiller PE ratio, which measures how expensive or cheap the S&P 500 is by looking at historical earnings trends. At 38 times earnings today, the Shiller PE ratio is well above the average of 27 times. But there are some important points to keep in mind. First, valuations don't reliably predict short-term returns. They tell us how much investors are willing to pay based upon their expectations about the future. Even when stocks appear expensive, markets can keep rising if business fundamentals remain strong. Second, while there are parallels to the 1990s tech boom, there are some key differences. Unlike the mostly unprofitable dot-com companies, today's market leaders are well established with strong profitability and healthy balance sheets. Third, not all bubbles pop, but can deflate over time. Valuations can improve if earnings growth remains strong. Some of today's enthusiasm reflects anticipation of higher future earnings, and corporate performance has justified many of these expectations recently. While broad market valuations are elevated, opportunities exist across different areas. This chart shows that large cap growth stocks trade at 28 times earnings, while other areas like large value and small caps have more attractive valuations with healthy earnings growth. The same is true across sectors. AI-related companies are concentrated in technology and communication services, but positive trends have broadened to other sectors with lower valuations, including financials and industrials. Including a range of sizes, styles, and sectors in your portfolio can help reduce concentration risk and improve overall valuations. Finally, time remains the most powerful investment tool. This chart shows that even the most dramatic market events can appear less severe when viewed over years and decades. Those who invested at the worst points in history, like the 1929 market peak, achieved positive returns if they held for 15 years and continued adding to their positions. The key is maintaining a diversified portfolio that can benefit from growth while managing risk. We hope you found these insights helpful. If you would like to discuss how these market conditions might affect your specific financial plan, please don't hesitate to reach out. We look forward to speaking with you.